When a financial market fractures, the collapse is incredibly fast. Trillions of dollars in paper wealth evaporate in hours, and the immediate, overwhelming instinct of the public is to find someone to blame. For over 400 years, dating back to the very first organized exchanges, regulators have answered that panic with a singular, reflexive response, banning the practice of short selling. Mechanically, a short sale works in reverse. An investor borrows a security they expect to fall in value, sells it immediately at the current market price, and holds the cash proceeds. Their goal is to wait for the price to drop, buy the shares back cheaper, and return them to the lender, pocketing the difference. Because they are trading with borrowed property, short sellers cannot simply walk away. They must hold a margin account and pledge collateral against the value of the borrowed shares. This creates a highly asymmetric risk profile. If you buy a stock, the worst that happens is it goes to zero. Your loss is capped. But if you short a stock, the price can rise indefinitely. The downside risk is theoretically infinite. If a heavily shorted stock rapidly rises, short sellers start taking massive losses. To close their positions, they are forced to buy back shares at any price. This triggers a short squeeze, a feedback loop of panic buying that drives the stock price violently upward. That is the mechanical danger. But in neoclassical financial theory, short selling is viewed as an absolutely essential mechanism. Academics argue that allowing investors to take offsetting positions is the only way to enforce the law of one price and ensure a stock reflects its actual value. This mechanical reality creates a persistent tension. Regulators view short sellers as a destabilizing force that accelerates market panics, while theorists view them as a vital tool for price discovery. For centuries, the debate relied entirely on theory and anecdote. To settle the argument, researchers at the NDER built a massive empirical dataset. They tracked daily return, volume, and issue data across 47 distinct equity markets over an 11-year period. By analyzing the specific laws and operational realities in every single country, they categorized the global market into 4 distinct regulatory regimes: countries where short selling is legally allowed and actively practiced, where it is strictly prohibited, where it is legally allowed but rarely practiced, and countries that actively changed their laws during the study period. With this data, they isolated 2 highly specific questions. First, does short selling actually improve the efficiency of a market? And second, do regulatory bans actually prevent market crashes? By looking at hard data rather than the emotional aftermath of a panic, this study provides an objective arbiter between the regulator's fear and the academic's theory. The immediate challenge in settling this debate is quantifying market efficiency. There is no single dial or gauge on an exchange that measures how perfectly assets are priced. To solve this, researchers utilized a methodology developed by Mork, Young, and Yu, relying on a concept called stock price synchronicity. Inefficient markets show high co-movement. Lacking specific information, the entire market moves as a single herd in lockstep. Efficient markets demonstrate the opposite. Investors acquire firm-specific data and act quickly, causing individual stocks to chart highly independent, intersecting paths. Theorists assume that short sellers are the primary agents performing this work. By identifying overvalued companies, short sellers inject highly specific, negative information into the price of individual stocks, breaking them away from the broader market trend. If the theorists are correct, the data must show a mathematical reality. Markets that allow short selling must demonstrate lower overall stock synchronicity. To test this, the researchers ran a precise statistical regression. They took the weekly returns of individual stocks and regressed them against the value-weighted return of their national market to find the R-squared value. Visualizing regression table 3, look at markets where short selling is practiced. The correlation coefficient is negative 0.431. Short sellers measurably reduce the R-squared of the average stock, a result that holds firm even when controlling for country GDP, size, and industry concentration. In economic terms, removing short sale constraints increases the idiosyncratic risk of the average stock by exactly 27%. The empirical evidence proves the academic theorists are correct. Short selling dramatically accelerates the market's ability to incorporate firm-specific data, heavily improving overall daily price discovery. But regulators do not ban short selling because they oppose daily efficiency. They ban it to prevent systemic panics. To evaluate their side of the argument, we have to look at the anatomy of a crash. This chart shows a log normal distribution curve. The mathematical fingerprint of a market crash is found on the far left edge of this curve, in a concept called negative skewness. It measures the frequency and severity of extreme price drops. To explain how short selling might impact this left tail, economists Harrison Hong and Jeremy Stein developed a heterogeneous agent model. Their model observes that investors possess different information about a stock's value. If short selling is banned, investors with negative information about a company are constrained. They cannot act on their research unless they already own the stock. Because pessimistic investors are locked out, negative data builds up silently. Once the price drops for other reasons, the sudden release of all that hidden pessimism triggers a violent, aggravated crash. This model creates a testable paradox. Does banning short sales prevent severe left tail drops, or does the forced buildup of hidden information guarantee them? Plotting Table 4's micro-level skewness data shows the regulators are right. Individual stock returns are visibly less negatively skewed when short selling is prohibited. Bans successfully protect specific companies from sudden, severe repricing. But regulators are not tasked with protecting individual companies. Their true mandate is to protect the macro market, the index level, from absolute systemic collapse. And when the researchers ran the exact same skewness tests at the market level, the effect completely vanished. Once controlling for macroeconomic factors, the presence or absence of short selling has absolutely zero statistical significance on market-level skewness. Researchers tracked extreme market returns, drops exceeding 2 standard deviations. Bans don't reduce their frequency. This creates a jarring paradox. Banning short sales protects individual bad companies from sudden repricing, but it completely fails to prevent the broad, systemic market panics that government regulators claim to be stopping. To fully grasp why the macro market ignores these bans, we have to look past the regression tables and examine the actual shape of market returns generated across the 11-year dataset. This chart displays the kernel estimation of return distributions. One curve represents markets with constraints, the other markets without. The curve allowing short selling takes a distinctly leptokurtic shape, with a significantly taller peak and fatter tails than a normal distribution. This shape proves short sellers create a volatile daily market, forcing prices to constantly adjust. But follow the lines to the extreme left boundary, the crash zone. Both allowed and prohibited curves reach the exact same depth of extreme negative returns. Allowing short sellers absolutely increases daily friction and volatility, but the ultimate depths of a systemic market crash is entirely immune to regulatory bans. We can confirm this immunity by looking at the cleanest data available, the 5 specific countries that actively changed short-selling laws during the study period. Observing Hong Kong and Malaysia, Norway, Sweden, and Thailand acts as a perfect control group, isolating the exact mathematical impact of lifting a ban on a specific market. This scatter plot maps their transition, plotting market synchronicity against market skewness. When these countries lifted their restrictions, their stock co-movement reliably dropped, idiosyncratic risk increased, proving the instant return of daily market efficiency. But their change in crash frequency was completely mixed. In Thailand, the frequency of extreme negative returns actually dropped. In Sweden, it slightly increased. The data shows highly specific, country-by-country reactions rather than a universal surge in panics. This proves the ultimate reality of the data. Lifting a short-selling ban guarantees better daily price discovery without guaranteeing a future market collapse. The global dataset leaves us with dual empirical findings. Banning short sales applies strict, measurable costs to a market's efficiency, while providing zero measurable benefits to its macro-level stability. Yet, despite this hard data, history shows that during moments of intense financial crisis, politicians and regulators will almost always suspend short selling. They do this because the psychology of the ban is incredibly powerful. Outlawing short sales provides the illusion of control during a panic. It fulfills a political need to act, rather than an economic need to stabilize. A short-selling ban acts as a regulatory placebo. It treats the anxiety of the moment, while actively starving the market of the idiosyncratic information it desperately needs to find true value again.